Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. Returning to the show today is special guest Paul Lloyd. Paul is a certified financial planner at ACT Advisors, where he focuses on developing financial plans for credit union executives. Paul has been doing some substantial analysis of planning strategies for credit union leaders, and he joins me today to share his latest research. Paul, welcome back to the show. Now, I know you've been working on your latest research paper on the 125% executive. Tell our listeners, what does that mean?
In this paper, we're proving that we can increase financial outcomes for credit union executives, which is measured by median terminal asset value, by as much as 25% by simply optimizing the use of their existing resources.
Wow, Paul, that was some of the geekiest words we have ever heard on this podcast. I think you said you're going to increase the amount of money they have at the end of their lives by 25%, and you're going to use some fancy financial planning software to do that. Is that right?
Yeah, that's what I said in a nutshell.
Awesome. Well, tell me more about that. Take us through how that works and why do credit union executives need that in the first place?
Okay, well, most financial education content is really built more for the rank and file employee who's able to save enough for retirement through traditional means. But once people move into the executive suite, we find that there are just not enough tools out there to address the needs that they have with their enhanced benefits packages. Over the life cycle of the credit union executives, we see 401ks, 457Bs, collateral assignment split dollar plans, stay put bonus, and each of those have different timings, tax consequences, et cetera, that we need to consider that just isn't addressed by most traditional education out there.
All right. Well, that makes sense, right? Because most folks do not have 457Bs and collateral assignment plans. So, of course, traditional education is not going to address that. So tell us a bit more about how can you improve the outcomes by 25%? What does that mean?
Through the use of a case study, we examine three basic issues, which are income timing, risk allocation, and income tax planning. And through these three concepts here, we show how you can piece your benefits together in a way that's different than what you might have always heard from traditional financial education, in a way that improves your outcomes substantially over your lifetime.
Now, walk us through that. What would you say? You said income timing?
Income timing. Yeah, that's the first one. We'll take them one by one here. First one, as I said, is income timing, and that's centered mainly around the withdrawal of 457B assets. 457Bs are one of the most common benefits that we see out there in addition to the traditional 401k. If you were to follow most conventional wisdom there, an executive would typically say, well, that's an entirely taxable account, so I think I'll take that out over some period of time, maybe 5 years, 10 years, and spread that tax liability out over time. But we see a lot of these on a regular basis, and one of the major concerns is that the 457B plan, even if it's funded by the employee, is technically an asset of the credit union, so it's at risk of forfeiture. So many executives want to take that money out as quickly as possible. In our case study, we've compared taking it out over a period of time, for instance, 10 years, versus taking it all in one lump sum after retirement, as we see a lot of executives do.
So they take it out in one lump sum because they're worried about substantial risk of forfeiture. And I've heard that too, so that makes sense. But are you saying that there are other reasons to take it in one lump sum? Tell us more about that.
What we see with a lot of executives is if you take that tax hit immediately after retirement by taking out the 457B plan, it sets up a number of years between retirement and age 72 when you have to start taking out money from your 401k, in which they can live on a combination of their tax-free split dollar plan and personal savings. So this results in many years where they have unusually low effective tax rates.
I'm used to seeing credit union leaders in the 30% plus tax bracket very consistently. So when you say unusually low, what are we talking about?
In many cases, we're talking about single-digit effective tax rates. Many of these executives are going from 27, 28, 30% effective tax rates in their last few working years, all the way down to, in some cases, zero.
Wow. If you follow traditional thinking, you've got your 457B and you take it out over 10 years, you're going to be paying what's called a medium rate of tax over 10 years, but you'll never peak up into a big high tax bracket. So your data is showing that going and paying it all the top rate in 1 year and then paying almost no taxes in the additional years, they're going to come out ahead.
That's correct. And it also sets up a couple of other important tax planning strategies. The first one is healthcare. One of the biggest concerns for any retiree, if they're retiring before age 65 when they qualify for Medicare, is the cost of private health insurance. So in the example that we use, the executive retires at age 62. They take the 457B income the next year at 63. And then they have a couple of years there where they have to find their own health insurance through the private exchange. So since they have very little taxable income in those years, they're able to qualify for premium assistance tax credits for purchase of healthcare through the Obamacare exchange. Instead of seeing insurance rates in the neighborhood of $25,000 to $26,000 a year for a couple, they're able to qualify for tax credits that lower their cost to only about $1,400 a year. So that's a massive savings for those 2 years.
Per year, $26,000 a year in health insurance costs. I know that's what we're used to seeing here is around $1,100 per person per month, right?
That's right.
You can get their after-tax credit cost down to maybe $100 a month from $1,100 a month. Is that what I'm hearing?
That's right. People always kind of look at us like we're crazy a little bit with that. For many executives who've been highly compensated for a number of years, they think that's unrealistic to pay that little for health insurance through exchange. But it's a situation we can create through proper timing of the income and also something that's made possible by the tax-free nature of that split dollar income.
Yeah, well, I know that the split dollar plan has the biggest impact on someone's financial analysis of anything that we've ever seen. But this idea of taking the 457B in one lump sum, so it ends up in lower overall amount of taxes. Is that right?
That's correct.
So low overall taxes, and then it potentially sets them up to qualify for super low health insurance through the Obamacare tax credits. Is there anything else?
The other tax planning opportunity we look at is Roth conversions. The 2 years that they're qualifying for tax credits for health insurance, they have to be very careful about how much income they recognize, either through 401k withdrawals or recognition of income from their personal savings. But after age 65 and they're on Medicare, they still have until age 72 while they still have super low effective tax rates. So these are prime opportunities for Roth conversions, which would be converting traditional pre-tax 401k savings over into Roth. That way they could recognize the income at lower rates than they would have a few years down the road. And then they're also reducing the size of their pre-tax account that's subject to R&D at age 72.
In the example, which our listeners can see in our blog at act-advisors.com. On our blog, you can see the example that Paul has been referencing. So this person ends up with a 457B balance of $100,000, it looks like. It's going to get a collateral assignment plan of $100,000 a year in income and as a $150,000 rollover IRA. How much did this person end up converting in their Roth? Do you have that in the data?
Between age 65 and 72, they converted a total of $140,000 from 401k to Roth during those years.
Okay, so a reasonable amount, not a humongous amount. And they did that because they had those single-digit tax opportunity and they got past 65, right? So they were past 65. So now they got Medicare for their health insurance. They don't have to worry about the Obamacare income limits anymore. But when they do these Roth conversions, they still have to watch out for Social Security taxation, right? Right. Assuming most executives are probably paying tax on 85% of their Social Security anyways, then these Roth conversions are a way for them to reduce their future required minimum distributions by taking at a low tax rate now. And I know in your example, which again, our listeners can see, and not just here, we project that this executive is paying no more than a 3% effective income tax rate between age 64 and age 71. And then those required minimums kick in. and they go up to a 12% plus bracket for the rest of their life. So the difference between those things, right, that's the Roth conversion opportunity. Is you could say, take that 3% bracket up to 10, well, you're still saving money. So let's move on to the next subject. I think after the income planning was about risk allocation. Talk me through that.
Perhaps this is the most important factor that we look at. Most traditional education or financial wisdom would tell you that as you approach retirement, you should gradually taper down the risk levels in your retirement accounts. You don't want to have those high levels of volatility when you're getting close to consuming the money. But the examples that we present is showing that this executive does not need to take any withdrawals from the 401k at age 62 all the way until they turn 72 and start having to take the money out through required minimum distributions. So that's a 10-year time frame, and that's way more than enough time for the executive to keep a higher risk level in their 401k instead of backing off from, say, an 80-20 mix of stocks and bonds for retirement. We have this executive continuing that aggressive stance all the way through age 70 when they're getting close to the R&D age.
Well, let's talk about the example. And then we've had a previous podcast on this subject. In our example here, we've got the executive retiring in the year 2036. So if this person went out and did what most people do, if you listen to our podcast on target date funds in 401ks, so that I think it's something like 85 cents on each dollar that goes into a 401k goes into a target date fund. And that makes sense, right? Because they're easy and they're done for you and they automatically get more conservative generally. So they make a lot of sense. However, if this credit union executive picks a 2035 target date fund, that fund is built around the assumption that she's going to retire and then begin spending the money in the year 2035. So I assume that means she's probably going to have a middle of road level of risk in that target date fund, right?
Right.
And so what you just said is that because she's not actually going to consume any of the money until not 2035, but 2045, and then even then, the amount that you're projecting her to consume is very modest, that she could be substantially more risky, like maybe even twice as much risk as would be in a target date fund for 2035. Is that right, Paul?
That's right. Really what we're saying here is that the date in which you plan to consume the money or start consuming the money should drive that risk allocation more than your retirement date. I think that's traditional thinking is look at the date I'm retiring and not really drilling down to when am I actually going to start using the money.
That's a huge takeaway. So time the risk you take in your assets along with the consumption of those assets, not a different thing, which is your retirement date. Because if you don't consume the assets for a long period of time, and even then very nominally, then your risk should be very different than traditional education would say for your retirement date. We've talked all about the benefits to the credit union executive from this 25% more money they get at the end of their life as a result of doing this detailed planning. What about the credit union? You know, the credit union, as we know, is generally paying for this kind of work for executives in the $500 million plus credit union space. So what's the benefit to the credit union of doing this kind of thing?
First of all, I think one of the biggest impacts to the credit union is that engaging in this process of optimizing a financial plan can help the executive fully realize the potential of their benefits package. Credit unions spend hundreds of thousands of dollars every year to fund collateral assignment split dollar plans, 457B and F plans. But financial planning is perhaps the cheapest benefit that they could pay for their executive and make the most impact. For instance, a financial planning subscription service costs about $6,000 a year. As we're showing through our plan here, it's able to maximize the benefits that the credit union executive has and improve their outcomes by 25%. So that's a lot of bang for your buck there. And also it helps those benefits become a little more tangible to the executive and brings them a certain peace of mind that helps them focus on leading their credit union versus worrying about their own financial plan.
Yeah, I know in seeing the work that you've done in this area that the tangibility is really big because in your planning, you show the executive that in the year when she retires, in our example, in 2036 and 2037, she's going to need to get $144,000 out of the plan in order to live. And where is that money going to come from? It's going to come from the money that came out of the 457B that you paid tax on. And the money that is in there is going to cover her for the next 3 years of her living expense. So that tells you that the money that she got from the 457B should be invested in a really conservative way, right? Because we know she's going to consume that in this period of time. And this just being in the stock market with the money that is going to be consumed that quick, it just doesn't make sense. But you offset that loss of potential earnings by taking much more risk in the 401k, because we know that money is not going to be needed for a decade or more. So I think that's the kind of tangibility you're talking about. One of our clients refers to that as her runway. She wants to know, where is her income coming from for the next 5 years? And she wants that to be in pretty conservative positions, because she just doesn't want to have to worry about where I'm going to be able to pay for my groceries for the next several years. When you do that kind of specific planning, all the executives understand exactly where it's going to come. Instead of just sort of funding this account that's growing and growing and growing, you're funding this account that you can tell exactly when it is you're going to consume it and use it to pay for your trips or to pay for your whatever it is, the lifestyle choices that you would like to make. All right, Paul, thanks very much for being on the podcast again today. Thanks for your information and all your research. We're going to post this research paper available for download at act-advisors.com under Credit Union Executive and also on our blog. Thanks, everyone, for joining us on See You on the Show. That's all the insider credit union knowledge we have for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.